I'm Ben McKinnon. I'm a second year, 5-year MBA major from Raleigh, North Carolina.
Charlene Easton, second year, 5-year from Jersey.
Kaylin McDowell, second year, 5-year from Atlanta, Georgia.
Rachel Ransom, second year from Stafford, Virginia.
Welcome to our workshop.
What most people your age don't know is that accounting is one area that is relevant in all workplaces and to all individuals. Without understanding accounting, people can end up spending more money than necessary, have some of their money stolen from them and not know about it, or worst case scenario, end up in prison. As one of the absolute most important aspects of business, accounting is something that us adults take very seriously. General accounting can be defined as an information system that identifies, records, and communicates relevant, reliable, and comparable information about an organization's business activities. Through the analyzing process of one's accounting-related information, businesses are able to choose their best fitting business model. Now, without you all even telling us, we can already tell by our faces that you don't think accounting is cool. But trust us, we didn't think it was cool either when we first heard about it. So I'm sure you all are thinking that accounting and accountants are boring, but that's far from the truth. Accountants are just regular business professionals who have normal social lives just like anyone else. They may have certain times throughout the year in which they're more busy than other people, but they are just the same as you and me. Also, accountants are not math wizards, as some people may think. All they use are the same addition, subtraction, multiplication, division skills we all learned in elementary school. Maybe you already knew this part, but accountants usually have great organizational, logical, and communication skills. The accounting equation is the most basic part of accounting. To do anything as an accountant, this is the first thing that you need to know. The equation is made up of assets, liabilities, and equity. Assets are things that a company owns, such as equipment or supplies. Liabilities are the things that a company owes to someone else, such as a credit expense. And equity consists of assets owned by stockholders in the company, such as common stock. Where assets and liabilities are the only categories related to their respective descriptions, equity consists of 4 different categories: common stock, revenue, expenses, and dividends. Common stock and revenue contribute to the total equity, whereas dividends and expenses take away from the overall equity.
One of the most important terms to know relating to the accounting equation is debits and credits. Each account in the accounting equation has a specific normal balance, debit or credit. An account's normal balance increases the account balance. The opposite balance will decrease the account balance. One way that we remember which account has a debit or credit normal balance is by using the acronyms ADE and LCR. Accounts beginning with a D and E and A have a normal debit balance. Accounts beginning with L, C, and R have a normal credit balance. We display the effects of the debit and credit transactions through the T accounts, which are pictured here. To ensure that the accounting equation remains equal on both sides, each entry must affect 2 accounts. Now we will further explain what an entry is later, but we want you to understand one rule. What is done to one side must be done to the other. Additionally, if there are 2 entries that are affecting one side of the equation, the impacts must be opposite. For example, let's say we bought supplies for our company with our company's cash. In dealing with 2 asset accounts, we would debit our supplier account and credit our cash account for the same amount. Now that we've gone over the basics, let's talk about the accounting cycle. The accounting cycle makes up the steps in preparing financial statements. It is called a cycle because the steps are repeated each reporting period. The 10 steps are analyze, journalize, post, unadjusted trial balance, adjustments, adjusted trial balance, financial statements, close, post-trial balance, and reverse and post. However, the last step is optional, so for simplicity purposes, we are going to leave it out of this presentation. This chart of accounts lists a number of commonly found accounts utilized within the accounting equation. Some examples include prepaid rent as an asset, salaries payable as a liability, and rent expense as an expense under equity. Below lies a complete list of entries for our company, closed for you. We will be utilizing these entries to perform the accounting cycle. In every list of entries, we begin by showing our beginning balance of retained earnings from the previous period. In our case, we had $0 in retained earnings begin our 2018 fiscal year.
The first step in the cycle is to analyze. We analyze transactions to prepare for journalizing by using the accounting equation. The first thing we do is create a chart with each asset account on one side and each liability and equity account on the other side. Then set all of the asset accounts equal to the liability and equity accounts. Lastly, create a running balance of each account. In the end, total assets should equal total liability and equity. Journalize. Step 2 is to record the debit and credit entries into a journal. Through reading the entries already provided, we can determine what accounts are being used and what amount we should add or subtract to those accounts. The action is done through journalizing. To begin this step, we date the transaction, write the debit account, and write the debited balance. Next, enter the title of the credit account along with the credited balance. Then, below the entry, you can provide a brief explanation of the transaction. The first entry reads, on January 1st, closed for you, owners each invested $250,000 cash into the company in exchange for common stock. Knowing this information, we will debit cash for $1 million and credit common stock for $1 million. By posting our journal entries to our journal ledger, we are able to transfer all of the debits and credits into each account's separate T account. This gives an easy visual breakdown of how each account has been affected throughout the period. First, find the debit account and fill in the date and debit amount. After all entries are posted to the account, write the total. Lastly, repeat steps 1 and 2 for all normal credit accounts and credited amount. This step allows us to summarize the total amounts of each account in the general ledger into one document. We start by transferring all of the account titles and their respective balances from the ledger to the unadjusted trial balance. Then calculate the total and total credit amounts to ensure that the debit and credit totals are equal. If they are not equal, go back to your journal entries, then analyze to see where you made a mistake. Remember, this is the unadjusted trial balance for a reason. These numbers will not be the final numbers we take to our financial statements.
Adjustment takes place when you buy something in advance of when you will use it, or when you use something in advance of paying for it. As time goes by, the amount left over decreases. Examples include prepaid insurance and unread revenue, salaries, and technician services. In order to properly conduct an adjustment, you might identify how much of a product or service has been used up to this date. Then subtract the amount from the total amount purchased. Specifically, in the debit account, credit the amount used under the asset account and debit the same amount under the equity account, expense account. The amount utilized would be the same amount placed in the adjustment area in the T accounts. Adjusted trial balance. This step summarizes the total amount each general ledger account, but it also takes into consideration all adjustments made. This document includes the unadjusted balances, the adjustments, and the adjusted balances to demonstrate the changes made. After starting with the adjusted trial balance, add all adjusted debits and credits to their respective accounts from the adjusted column. Then, total the debit and credit side. They should equal the same amount. If not, just as before, work backwards from the step to see where the mistake was made. Financial statements. From the looking at the adjusted trial balance, we now have all the information we need to prepare the statement of retained earnings, income statement, and balance sheet on that order. It is important to follow the order stated because each document provides information in the following document. To prepare an income statement, you take the total revenues and subtract the total expenses. This will show either your net income or your net loss. Next, prepare the statement of retained earnings. First, take the beginning retained earnings balance given to you. In this case, it is $0. Then, add the net income from the income statement and subtract the dividends. Lastly, create the balance sheet. To complete this statement, use the accounting equations all permanent accounts. Permanent accounts include all assets, liabilities, common stock, and ending retained earnings found in the second statement. Closing. The closing process is the important step in the accounting cycle that prepares accounts for recording the transactions of the next period. During this step, we clear out all of the temporary accounts. Temporary accounts include revenue, expense, and dividends. All accounts not present in the balance sheet. First, close the revenue and expense accounts by making their balances $0. The transfer revenue and expense account balances to the income summary account. This balance is equal to the net income or net loss. Next, close the income summary balance to the retained earnings. Then, close the retained earnings to the dividends. After entries are posted and journalized, all accounts should have a balance of $0. They are now to be considered closed. Post-closing trial balance. The purpose is to make sure that all the debits equal all total credits. If all calculations are correct, This document should have the same balances as the balance sheet.